Industry expert, author, and founder of Understanding Reverse, Dan Hultquist, contributed a column last week to Housing Wire's Reverse Mortgage Daily. And it reveals two often overlooked facts about the HECM's expected rate that's used to determine the federally insured reverse mortgage's principal limit. So today, here are just a few excerpts from Dan's column. First, writes Hultquist, HUD's principal limit tables for expected rates are published in 1/8 percentage increments. Hultquist writes, because the U.S. Department of Housing and Urban Development, or HUD's lookup tables, are published using expected rates in 1/8 percentage increments, 6.625, 6.75, etc., we must use the nearest 1/8%. For example, a 2.5% lender margin combined with last week's 10-year constant maturity treasury rate average, 4.22, would produce an expected rate of 6.72%. Now, when looking up the borrower's principal limit factor, we would use 6.75%. Second, higher expected rates reduce borrowing capacity, while lower expected rates increase borrowing capacity. So it is understandable that HECM prospects want to know how unlocked expected rates could impact their principal limit, says Hultquist. And it's a very valid question. We cannot determine the precise percentage, says Hultquist, until we know both the relevant age and the expected rate. Depending on those two factors, the impact could be 0.14 to 0.19% of a prospect's home value. Nevertheless, the average impact of a 1/8 percentage change in the expected rate is a little over 0.6%. For example, a 1/8% change in the increase in the expected rate on a home appraised at $500,000 would reduce the gross principal limit by approximately $3,000 on average. Earlier this month, a federal judge determined that the majority of the arguments that were laid out by Texas Capital Bank, known as TCB, against Ginnie Mae, have merit and are worthy of the trial process and will be allowing the case to continue. The majority of the claims made by Texas Capital Bank will be allowed to continue, including one that alleges that Ginnie Mae seeks to declare by fiat or decree that TCB's only recourse for repayment is RMF, a bankrupt entity with few, if any, assets, that according to the original complaint as reported in Housing Wire by Chris Clow. Now, Housing Wire reports that the presiding judge, Matthew Kaczmarek, ruled in the U.S. District Court for the Northern District of Texas that Ginnie Mae's extinguishment of reverse mortgage funding, or RMF, from the home equity conversion mortgage, or HECM mortgage-backed security program, substantially impacting the bank's first priority lien over certain assets, was not arbitrary and capricious as alleged, and they sided with Ginnie Mae on that point. However, they did allow most of the other expressed elements of TCB's complaint to continue. TCB attorneys also claim that Ginnie Mae's positions are not supported by previously approved agreements, nor are they supported by law, reports Reverse Mortgage Daily and Housing Wire. Now, on top of this, TCB claims that in March 2023, and this is interesting, the FHA's current commissioner, who also holds the title of Assistant Secretary of Housing and Federal Housing Commissioner at HUD, stated that FHA disagrees with Ginnie Mae's position. When RMD asked Texas Capital Bank about this latest legal development, the bank referenced an earlier statement they had made in October of 2023. By the way, that was the time that the case was filed, saying, unfortunately, Ginnie Mae has refused to honor multiple specific commitments it made to Texas Capital, to honor its legal obligations to Texas Capital, and to desist from its unlawful seizure of collateral that rightly belongs to Texas Capital, said the statement in part. Adding, those actions taken by Ginnie Mae have left Texas Capital no choice but to pursue legal action to protect the firm's rights. Failure to take action under these circumstances would not only harm Texas Capital, but also have a chilling effect on the industry, including the ability and willingness of Texas Capital and others to participate in programs like this one. Just 1 year ago, most investment banks and Wall Street investors were predicting a U.S. recession due to the impact of persistent inflation and higher interest rates. Some 65% of economists polled by Bloomberg in March 2023 were convinced the U.S. economy was headed for a serious downturn within a year. But with U.S. consumers and businesses proving their resilience over the past year, Wall Street's top minds have mostly abandoned their recession predictions, reports Fortune. Even what was long considered to be the obvious alternative to a recession, a so-called soft landing in which inflation fades but the economic growth is weak, is increasingly in doubt. Instead, 45% of investors now believe the economy is headed for a no landing scenario where inflation sticks slightly above the Fed's target rate of 2% and economic growth remains robust, according to Deutsche Bank's March Global Markets survey. Some 38% of respondents to Deutsche Bank's survey still expect a soft landing, but just 17% expect a hard landing or recession, a considerable shift from how economists felt just 1 year ago. The news comes after Fed Chair Jerome Powell brushed off two hotter-than-expected consumer price index reports in January and February that had some investors concerned about the threat of persistent inflation and a more hawkish Federal Reserve. Powell told reporters at a March 20 presser that the hot inflation reports, quote, haven't really changed the overall story, which is that of inflation moving down gradually and sometimes a bumpy road towards 2%. Deutsche Bank's global head of economics and thematics research, Jim Reed, described many investors' new no-landing outlook just after the Fed chair's comments last month. Basically, investors are expecting slightly above target inflation to persist, which is typically bad for stocks because it signals potentially higher interest rates or at least fewer rate cuts than expected. But this time, after the Fed brushed off two recent hot inflation reports, and economic growth remaining strong, we could be stuck in a Goldilocks zone in the near term, according to Reed. The Wall Street veteran noted the U.S. stocks had their best week of 2024 after Powell's comments last week because the Fed seemed very confident of their ability to cut rates in June, even with the recently elevated inflation prints. Another reason that markets are performing so well, even as investors raise their inflation forecasts, could be their faith in the Fed's willingness to ignore minor increases in consumer prices moving forward. Reed noted that 47% of the survey respondents believe that the central banks should tolerate an extended inflation overshoot. But for now, it seems investors are more worried about inflation than a recession, and they don't seem that much concerned about an aggressive Fed coming in to wreck the party if inflation does return. As a result, only 13% of the respondents to Deutsche Bank's survey said that they expect a U.S. recession this year, down from 59% just 3 months ago. Now, I have to add that this column was written just before last Thursday's release of the Consumer Price Index, and it was the third month in a row that the annualized CPI increased. So March was 3.5%, not what the Fed wanted to see. And there are even some Fed governors talking about the potential of interest rate increases as part of their policy should they continue to see inflation accelerate. For more details on that, be sure to go to HECMWorld.com or our YouTube channel and watch our latest video on inflation and interest rates. And that's a wrap for us here at HECMWorld. Thank you so much for joining us. Don't forget, you can subscribe and listen to this podcast as well. We have an audio companion. You can find that on Apple Music, Spotify, Podbean, and of course at HECMWorld.com. Don't forget to subscribe to our YouTube channel. That way you never miss one of these episodes. And we do have chapter markers, by the way. If you're watching on YouTube right now, all you have to do is move your cursor right over the scrub head or where the play bar is, and then you'll see the chapters for each of the stories in our segments. Thanks so much for joining us. Be sure to thank our sponsor, by the way, Lenderful Solutions, by clicking on the banner on this page, and have a great week.